Great. Hold on one sec. Can you see my slides?
Yes.
Perfect. Okay. I'm sorry, just need to do one thing. Okay, perfect. This is joint work with Mary Amiti at the Federal Reserve Bank of New York and Sang-Hoon Kang, who's a graduate student at Columbia. And the usual Fed disclaimer applies. So the question that we're trying to get at in this paper is, how did the trade war affect factor returns, welfare, and investment in the US economy between 2018 and 2019. So we know from many stock market event studies that trade policy announcements affect firm profitability. But the question that we're trying to think about is, how do we move from these types of findings to an understanding of their impact on real wages and welfare? And this is part of a larger problem associated with estimating specific factors models that arises because when researchers estimate a specific factors model, they identify movements in relative factor returns, but not aggregate returns or the aggregate price level. So what we're going to do in this paper is develop a modified version of the specific factors model that lets trade shocks affect firms through output, import, and domestically produced intermediate prices. And then we're going to show that a trade shock's impact on expected real wages can be written as a function of its effect on the expected returns of firm-specific factors and aggregate prices. To do this, we're going to develop a method of identifying the impact of a trade shock on expected aggregate profits, and not just the relative returns of firms, by using a stock market event study. And then we're also going to use an event study to identify the impact of trade war announcements on aggregate prices over a 10-year horizon by looking at how trade war announcements affected the spread between nominal and inflation index bonds. And that lets us back out an inflation rate, which we can then use to back out a movement in the expected price level over that 10-year horizon. So let me just quickly summarize the main results from this exercise. So we find that trade war announcements led to large changes in firm profitability and real wages. So one of the findings from our event study is that these trade war announcements led to an almost 9% fall in stock prices. Since we're working with the full set of listed firms in the US, that equals a $2.5 trillion decline in the returns of listed firms. So it's a big movement in stock prices. Now, in terms of what this did to expected wages, it also, seen through the lens of our model, it's associated with a 10% rise in expected real wages over the 10 years after the start of the war. We also, interestingly, are going to find that tariff announcements reduced expected inflation. So this drop in expected inflation implies about a 2% drop in the expected price level over a 10-year horizon. And then, similar to other studies, we're going to find that the aggregate welfare effects were relatively small. That is, the trade war produced only a 0.15% decline in real income. And that's consistent with the fact that you're getting a big drop in the returns to firms and a big rise in real wages. But you may wonder, well, why is it that tariffs lower inflation expectations? We'll present some evidence that, seen through the lens of a Q theory of investment model, it probably lowered the output gap. And here the method, the links are lower firm profitability implies that there's lower returns to investment. But if you have lower returns to investment, you end up in a Q model with lower investment. And since investment is part of GDP, a lower output gap, which in a model with a Phillips curve is going to lead to lower inflation. And so one of the other findings in the paper is that the decline in firm profitability probably lowered, we estimate lowered US investment rates by close to 4%. Okay, so let me just give you a little bit of a sense of how the model works. We're going to be thinking about two countries with identical homothetic utility functions. Home firms are going to produce and export differentiated final goods, and foreign firms are going to produce and export a homogeneous intermediate good. Home firms are going to produce using a constant returns to scale technology that's going to vary by firm, okay? And so that technology is going to, given in the equation on this slide, the output of firm F is going to be a firm-specific production function, which has elements that are equal to the labor employed by the firm, the amount of the specific factor employed by the firm, the amount of domestically produced intermediates used by the firm, and the amount of imports that the firm uses. And so this is going to differ from a standard specific factors model in that we've added in domestically produced intermediates and imports, right? So a standard specific factors model will only have labor and capital, which is this LF and VF terms. Now, in order to make the model tractable, we're going to assume that intermediates are produced using a technology that's identical to the utility aggregator. And what that does is it just simplifies our aggregate price terms so that the price level for intermediates is going to be the same as the price level for consumption. And both of these are going to be can be written as an expenditure share weighted average of the prices in the economy. And these expenditure shares are consumption shares. Okay. So now turning to the specific factors model, we're going to get an equation that's essentially the same as the standard Jones-Hat algebra, which is a link between log changes in prices and output prices with log changes in input prices. So in the standard specific factors model, that would be just wages and capital. But here we're adding in intermediate inputs and import prices. And these P stars here are the tariff inclusive import prices. Okay, so essentially as prices of inputs rise, that's going to lead to higher prices of final goods. Okay, and these thetas are just the standard cost shares of each intermediate input. Okay, so one of the challenges of taking this equation to the data is that we typically don't observe firm level prices. But we do not now know how to aggregate those firm level prices into a price index. That was what I showed you on the last slide, where we just simply multiply them by the expenditure shares and then sum across them. So if we take this equation at the top of the slide and multiply it by VF, which are those expenditure share terms, and sum across all firms, we get rid of this firm level price and it gets replaced with the overall price index. And then if we do a little bit of algebraic manipulation, we end up with this basic equation down here. So this equation gives you a lot of intuition for how movements in import prices and aggregate prices are going to be linked to movements in real wages. So let me just run you through the basic terms. The first term is the real change in labor costs. So this is the real wage times labor costs. The second term is the real change in payments to capital, the specific factors. And the last term is the real change in import costs. So what happens in a trade war? Well, that's going to raise the price of imports over here relative to domestically produced goods. And so this term is going to be positive in general. And so what that means is that the sum of these other two terms, the labor costs and the capital costs are going to have to be negative. And basically, what that's saying is that if firms are paying more for imports, they have less money left over to pay workers and capital. The second thing that you can see immediately from this equation, it's going to give us the identification that we're going to use, is that if we can observe what's happening to the relative prices of imports, and we know how the trade war affected the returns of each firm, as well as what it did to the aggregate price level, then we know what it did to real wages. And we're going to use that in order to get our results on real wages. So now let me just turn to the data and just take you through how we're going to do this really briefly. So this is a plot that shows you what happened to US average tariff rates over the course of the last 2 years. And you can see that there were 8 US tariff events that involved China. We're just focusing on events that deal with China. And we're going to identify trade war announcements as the earliest news mention of a new tariff, okay? So for each of these events, we find the first reference in the media. And then we also will do the same thing for Chinese retaliatory events. So we'll end up with 11 different events as part of this trade war. In terms of the data that we're going to use, our sample is going to be all listed firms that existed between 2016 and 2019. We're going to identify firms exposed to China as direct or indirect importers from China or exporters to China, as well as firms selling in China. And then our methodology is going to extract movements in share prices that's due to either the impact of an announcement on exposed firms, so that's going to be like a classical diff and diff event study, as well as the impact of an announcement on all firms. And we do that by filtering the announcements through a factor model, but I don't have time to talk about that right now. So then you can say, okay, so what happened to stock prices? So I'm not going to go through the full estimation. I just want to show you what the raw data looks like, which is going to basically give us the main results. So this is showing you what was happening to stock prices from 6 days before the event to the event. And the event always happens on day 0 in this plot. And you can see that there's not much happening to stock prices across all of these events leading up to the actual announcement. They were pretty flat. And then on the day that the tariff was announced, in total, stock prices fell by about 11%. And then they more or less stayed flat afterwards. So there's this discrete movement in stock prices that happens around these trade events, and it drives it down by about 11%. And that's going to be what's going to drive our estimate of what's happening to the specific factor. Similarly, you can say, well, what happened to the expected price level? So here we're inferring that from the 10-year expected inflation rates as that you can get from looking at the difference between inflation indexed and nominal bonds. And again, you can see that there's very little action happening up until the announcement date. And then you see that there's a big drop in expected inflation that happens on the day of the announcement, and it's pretty flat afterwards. And so the cumulative, the implied change in the price level is about minus 2% as a result of that. Okay, so I don't have much time, so I just want to finish up by just giving you main results here. So what happened to real wages? So what were the forces that were pushing real wages around? So we're going to say that we're going to find that real wages rose by 9.7, or expected real wages rose by 9.7%. And that's reflecting 2 different forces in play. The first is the direct effect of higher import prices. So that's this term over here. So the trade war raised relative import prices. And that effect alone would have tended to cause real wages in the US economy to fall by 4.1%, because firms are now having to pay more for imports. But there was a much larger negative movement in the returns to specific factors that we saw from the last plots, and so this term over here is minus 13.8%, and since you're subtracting a negative number, you're adding it in to this equation, and that gets us our expected real wage movement. In terms of welfare, we find that welfare declined by about 0.15%, and welfare in our model is made up of two elements. One is the additional tariff revenue that is generated, but then of course you have to subtract off the higher costs to firms in our model for the additional import prices. So I'm out of time. But I just want to kind of summarize that the small welfare effects of the trade war should not be seen as meaning that trade doesn't matter for factor prices. We see very large stock price declines. Those imply about a 10% increase in expected real wages. And then also the other finding is that trade war didn't raise prices, but actually lowered expected prices. And again, probably that was acting through the output gap. Okay, so that's it, and I will end here.
Thank you very much, David. George is the discussant.
Okay, you guys see my screen? Is that okay?
Yes.
All right, so great. I guess we've been tweeting in the background trying to let people know about this event. So I think people are having troubles getting onto the link. So if Nidhi, if you want to tweet the link again, that'd be helpful. So this is a great paper. I mean, you know, it's really a really nice empirical paper, and David did a wonderful job of laying out all the features that are in there. So just to kind of summarize, they're going to evaluate the effect of a trade war announcement on a bunch of different things. Asset prices, which is I think the key thing, and that's going to kind of drop 9% today. Inflation, there's going to be some negative effect, kind of long run effect over 10 years, and investment, which is kind of again a short run thing. And then this is key, they're going to apply a particular model to estimate the effect on wages. And these movements in wages are basically going to go the complete opposite way as asset prices. And you know, that's essentially a residual coming off of a model that has balanced trade, some kind of, I'll say, not very clear assumptions about long run adjustment, no labor supply response, and actually critically no capital accumulation in that model, okay? And then the net effect is going to be a tiny welfare effect, about 0.1% of GDP, which is, you know, at first blush, that's exactly what you would expect, right? Trade with China is about 2% of GDP. It's a tariff, it's not a trade cost, it's a pretty highly substitutable thing. So that's kind of what you would expect. So I think the puzzle here is, how do we get such big asset prices out of something that should have such a small welfare effect? Okay. So let me I'm going to kind of split my talk. I mean, it's 10 minutes, so I'm probably just going to talk about asset prices. But I'm going to talk about asset prices, effects of a permanent trade liberalization, kind of the welfare effects in a model, and the heterogeneous effects across firms. And then I'll talk a little bit about the macroeconomic effects and how these asset price movements should lead the aggregate economy in a particular way. So I'm going to do this through like a full-blown general equilibrium model that's kind of got all those features that David's model is abstracting from. If there's time, I can kind of talk about the typical business cycle effects of future tariffs and an off-the-shelf heterogeneous firm IRBC model, and some evidence from GATT shocks and some missing mechanisms, which here it's crucial. There's a lot of really interesting movements in inventories in these periods. So let me sort of kind of, so I've been doing some work with Carter Mix and then also with Horak and Kim Rule to try to understand how asset prices affect or how you can kind of measure the gains from trade from asset prices, and also how you can use asset prices to measure the expected path of trade policy. So this was kind of a really nice paper to sort of look at. So what I'm going to try to do is I'm going to try to take a general equilibrium model with heterogeneous firms making dynamic exporting decisions from work with Kim and Horak. And I'm going to use that model to look at how asset prices should respond to a trade liberalization. So everything I'm going to do is going to be the opposite of what David did. The key features of this model is going to be endogenous firm creation. Firms are going to differ by their productivity. They're going to make dynamic export decisions subject to sunk costs. And they're going to have to build up export capacity in foreign markets. And so some firms are going to be really good at exporting. Some firms are not going to be very good. They're going to produce with capital, labor, and intermediates, and there's going to be roundabout production. So this is, in many respects, this is kind of a standard international macro model with asset prices and trade. Okay. All right. So here's, again, I'm going to do, I'm going to look at like what the asset price implications are in this model of an unanticipated permanent fall in tariffs that's going to expand trade gradually with a short run elasticity of 4 and a long run elasticity of 12. Okay. And so what I'm going to do is I'm going to look at, as I said, we can think about the change in assets of asset prices of a particular firm with technology Z, kind of fixed export cost KF, and some shipping costs psi F. And we're going to look at, what's the value of that firm on impact when tariffs go from 10% to 0. So that's what this change in asset prices is. Okay. So again, for David, you just have to flip the sign. It's just going to be, that's going to be a trade war. If you want to think about a future tariff reform, you're going to scale these responses down by the discount factor and the survival rate. That's what this says. Okay. So most of my time is up now, I guess. So let me just sort of show you a picture, which is, when we're thinking about a model where firms are kind of bouncing. This is productivity on the x-axis. And then I'm going to look at the asset change on the y-axis. And so you can think about firms bouncing around with their productivity. And then they're going to start out as non-exporters, and eventually they're going to get a shot that makes them start exporting. And then over time, if they get a bad shock, they're going to leave the export marketplace. But if they start selling a lot in the export marketplace, they're going to have like a really bad technology to leave the export marketplace. That's what this second threshold is. Okay, so that's kind of a very standard, if you think about Baldwin-Dixit-Krugman type of model. So let's first look at what happens to asset prices for existing firms. So this is the change in asset prices of non-exporters. So you can see, if even a really unproductive non-exporter is going to get a gain in asset prices of about 4.5%. Why is that? Because, well, there's some chance in the future he's going to become an exporter. Okay. This thing looks a little non-linear. I don't really want to go into that, but that's really related to the option value being more valuable for small guys than for big guys. Okay, the second thing is the gains are going to be increasing in export participation and exposure. So, So here I'm going to look at an exporter. An exporter's asset prices are going to gain more than a non-exporter. That's his red line. And this is a pretty bad exporter, say like a guy who's only selling 2% overseas. If I go ahead and look at a really good exporter, that's this purple line, he's going to have a much bigger gain. Okay. So the important thing to get out of this is a big gap in the gains from asset prices, but everyone's going to gain from the trade reform. Okay, all right, that's what these lines say. And importantly, you can kind of see like even a really productive exporter, a guy who's selling a lot overseas, if he's kind of not productive in general, he's not going to gain very much because he's going to leave the marketplace anyhow. Okay, so this is going to kind of pick up a lot of the heterogeneity that David was talking about in his estimation in terms of these different firms. Importantly, what I can then do is I can also look in my model at what the welfare gain from this trade liberalization is. And that's what this red line is. Okay, that's the welfare gain in the aggregate economy. It goes up by about 7%. Interestingly, that welfare gain is basically tied to the asset price gain of the marginal exporter, this firm right here who's about to leave the export marketplace. So in this model, what we're going to basically see is we can read off the welfare gains from a particular subset of firms. So that makes it pretty challenging when we start thinking about like some of the results that David then put forward, which is, basically there's this really big asset gain, but no one else, the aggregate economy doesn't gain. So that to me is a really puzzling finding. So let me now show you what happens with the rest of the economy following this change in asset prices from this tariff change. I'm guessing. So that's what we basically say. There's a very strong connection between consumption, investment, and output in the short run. So here's, again, a trade liberalization. So everything in reverse for David's situation. We're going to basically have output is going to go up over the next couple of periods, and then it's going to stay high, and then mean revert. And then consumption is going to shoot up initially and then continue to grow over time. Okay, and this is over 10 years. All right. Now, if we look at investment, what's going to happen with investment? Well, people are feeling rich from a trade liberalization. They're going to accumulate more capital, but they want to consume first. And so investment collapses and then rebounds. Okay. So this is kind of, again, what we're seeing is kind of, what would become out of a standard model, which is a little bit different than what David was telling us. So just to recap, a trade-induced drop in asset prices will cut consumption and increase investment, which is kind of opposite of the data. The asset price movements should be in the ballpark of the welfare effects, which is not what David and Mary were telling us, which is really puzzling to me because that's pretty much in every model that I've written down, even a standard Mellitz model. And of course, this is basically what you would get with a contemporaneous shock. If we try to do this with like future shocks with endogenous labor supply, which is kind of the work I did with Carter, we're going to find that these shocks are going to have very similar effects, but they're going to be more expansionary in the short run. So I was just kind of paying attention to time, but I haven't seen notes from Andre, but I'm guessing he must have told me I'm out of time. Oh.
Sorry, I probably should have said that I'm using the chat to do the time notifications, so people who are talking should monitor the chat. Sorry about that.
Stop there.
Let me. So let's try to stick on time. We have about 3 minutes for discussion, but maybe we could start by using them for David to respond to George's comments. And if there's more time left, we can maybe field the question. But if not, then we'll do the informal discussion bilaterally. So David.
Whoops. Yeah. So thanks, George. That was great, and I definitely want to get a copy of your slides afterwards, so I can kind of run through it. Yeah, I think it's interesting that you get these the small welfare effects despite the big asset price movements. I mean, my interpretation of that is it's very much like a Stolper-Samuelson effect. I mean, you see that in specific factors models generally, that one factor gets a real increase in its return and the other one gets a real decline. But definitely need to think about that a little more, and I definitely need to think a little bit more about the dynamics. We're basically working with a static model at this point. So let me stop there and open it up for other questions if there are.
Yeah. So I guess maybe I'll ask a question to follow up to something you just said, which is, I'm having trouble understanding the economics for why wages, even real wages, go up here. So is it the case that the tariff is it really Stolper-Samuelson? So tariff went up in industries that are so labor intensive that's the effect that dominates the increase in the import prices? So
basically, right, you've got that zero economic profit condition, right? That's what's driving everything. And in these specific factors models, when you have those declines in one sector, you can get real wages moving the opposite direction, and that's just a feature of the model. So it's a good question to whether we can translate that into the skill intensity, and that's something I probably should have an answer for, and I don't have it right now, so I'm not going to conjecture about that.
Very good. So thank you, David and George. Let's move on to the next paper, which is presented by Fernando. So again, please monitor the chat for time left notifications. I should have said that before. But anyway, Fernando, take it away.
Okay. Can you see my slides?
Yes.
Okay. So thank you, Andre, for organizing this this session. So this is work in progress, joined with Lorenzo. So I'm going to start this presentation by looking at the data. So panel A shows the evolution of manufacturing employment and manufacturing establishments in the United States over the last 20 years. So the green line shows a decline in manufacturing employment that has been very well documented in recent research.
Sorry, Fernando, I think your slides are not advancing.
Yeah, your slides are not advancing.
What about now? No?
Now, yes. Yes.
Now, yes?
Yes.
Okay. So the green line in panel A shows a decline in manufacturing employment that has been very well documented in recent research. A little bit less known is the fact that during this period, there has also been a decline in the number of manufacturing establishments located in the United States. And moreover, from the figure, we can see that the evolution of employment during this period does not seem to be one-to-one with the evolution of establishments. And this is pretty evident during the last 10 years, where we observe a recovery of manufacturing employment, but a continued decline of manufacturing establishments. So a first goal of this paper is to think about a framework to take into account both labor supply decisions of households and production exit and entry decisions by firms that rationalize these patterns, and to use this framework to speak about how trade policy can impact the dynamics of manufacturing employment and manufacturing establishments in the United States. And the application is going to be the 2018 trade war between the US and its trading partners. So on the right-hand side, we see that firms and establishments moved very similarly. And this is just to say that in the paper and during the rest of the presentation, I'm going to talk about establishments and firms as the same thing. So a second goal of the paper is to study the effects of trade policy across space. And we want to do so motivated by the fact that the economic activity in the United States is very unevenly distributed. As an illustration, the upper panel shows the distribution of firms across US states. On the left-hand side, we can see a large heterogeneity varying from about 500 establishments of firms in states like Delaware, Wyoming, or Alaska, to more than 18,000 in Texas and more than 35,000 in California. Of course, I mean, this large spatial heterogeneity in the distribution of firms is in part driven by size. And therefore, on the right-hand side, we control by size. So we compute the number of establishments as a share of the total number of establishments in a given state. And still, we can see this large spatial heterogeneity, and we can see how manufacturing firms intensively concentrate in the Rust Belt states. The lower panels shows a similar picture shows a larger spatial heterogeneity in the annual entry rates of firms. On the left-hand side, in absolute terms, and on the right-hand side, as a share of the total entry in a given state. In the paper, we document the similar large heterogeneity in the distribution of manufacturing employment across US states. But not only that, but also we observe in the data that there is a spatial heterogeneity in the exposure to changes in tariff. So on the left panel, we computed the import penetration from the world. And we can see that some states such as California, New Jersey, Delaware, or Georgia have heavy exposure to changes in tariff from the world compared with the rest of the economy. On the right-hand side, we compute the import penetrations from China. And similarly, we see that some states such as California, Nevada, Tennessee, Minnesota are highly exposed to changes in tariff from China compared to the rest of the economy. So beyond studying kind of the effect of trade policy, the aggregate effects of trade policy on manufacturing employment and on the location of firms in the United States, in this paper, we want to go one step forward and we want to answer questions such that, okay, if trade policy does have a positive impact on the location of firms and does have a positive impact on manufacturing employment in the United States, where are employments and firms are going to be located in the United States? Are they going to go to states that are highly exposed to changes in tariff? Or are they going to go to states that are large and have a lot of employment and a lot of capital? Or are they going to go to places like Detroit, that has a lot of capital, unused capital, and potentially very low rental rate of capital, and labor is going to gradually move to those places. So in order to answer these type of questions in this paper, we develop a dynamic model that crucially is going to feature forward-looking decisions of households on where to supply labor, forward-looking decisions of firms on the entry, exits, and where to locate production, and capital accumulation. So just briefly to describe the environment, we are going to have a model with end locations. Locations are going to be countries and are going to be states within the United States. In the quantitative part, we're going to have several sectors, tradable and non-tradable sectors, but in the description of the model, I'm going to omit the sectors for simplicity. So each location is going to feature an initial mass of households, L, an initial mass of firms, M, an initial endowment of capital structure, K. Moving goods within the United States is going to be subject to trade cost, and moving goods across countries is going to be subject to both trade cost and tariff. And also moving labor within the United States is going to be subject to mobility frictions. So in the model, there are going to be several agents. So there are going to be households that decide how much to consume and where to supply labor. There are going to be firms that decide how much to produce and sell across locations. And crucially, they're going to make dynamic decisions on entry, exits, and production location. There are going to be capitalists that are going to rent land and structure to build new capital structure. And there is going to be a government that is going to collect tariff revenues. So in what follows, I'm going to briefly go over the decision of each of these agents. So starting with the household dynamic decisions, so households are going to consume in a given location and are going to decide where to supply labor tomorrow. We're also going to take into account in the model transitions, not only across location, but also between non-employment and employment. These moving decisions by households are going to be subject to mobility frictions, M, and subject to idiosyncratic shocks, epsilons, that are going to be a realization from a type 1 extreme value distribution that is going to allow us, as in recent literature, to aggregate the behavior of individual households. So in particular, using the properties of the type 1 extreme value, we can compute the gross flows across locations, where mu and I shows the fraction of households from N that move to I at time t. This is going to be a forward-looking equation that is going to depend on the expected value of location I tomorrow, net of mobility frictions relative to any other location. And this new parameter is going to govern, is going to discipline the mobility elasticity. So with the initial distribution of employment and the gross flows, we can solve for the whole dynamics of labor supply across location at each time t. So this is the labor supply part of the model. In terms of the production and trade structure, this is going to be pretty standard. It's going to be an economic geography model with monopolistically competitive firms that are going to produce intermediate goods. And these intermediate goods producers are going to make several decisions. They're going to make static decisions that are going to be pretty standard. how much to produce and how much to sell domestically and abroad in order to maximize profits. And they are going to make dynamic decisions that I'm going to describe in a second on entry, exits, and production locations. So these intermediate goods are going to be aggregated into a composite CES that is going to pin down the price index in each location at each time t. And this price index is going to depend on the mass of firms producing in each location and the price of each variety that is going to depend on factor prices that are going to be shaped by the decision of firms, households, and capitalists that I have been talking about. Turning to the firm's dynamic decisions, so entry decisions are going to depend on the value of each location. That is going to be determined by expected future profits, but also it's also going to be subject to entry cost. And crucially, in the paper, we model entry cost in units of capital. So what we want to capture here is that everything else constant could be attractive for firms to locate production in places like Detroit that has a lot of capital structure, very low rental rates of capital, and produce there and sell from there to the rest of the economy. Active firms, firms that are already producing in a given location, are going to obtain gross profits and going to decide whether to stay producing in the same location or exiting the location. And all these decisions are going to be subject to cost shocks that are going to be realizations from a type 1 extreme value that, similar for the case of households, is going to allow us to aggregate the behavior of individual firms. Using the properties of the type 1 extreme value, we are able to solve for the transition rates. So the fraction of firms that enters in a location N is going to be also a forward-looking equation that is going to depend on the expected value of that location, and it's going to depend on the entry cost. And since we are modeling the entry cost in units of capital, the entry cost is going to be given by the rental rate of capital, which is going to be an endogenous equilibrium outcome in the model. So we're going to have a capital market clearing condition. And this parameter var theta is going to govern the elasticity of the mobility of the entry of firms across locations. Similarly, the fraction of firms that stay producing in N is going to be a function of the expected value of that location relative to the option of exiting the location. And similar for the case of households, with the initial distribution of firms across space, and with these transition rates, we can compute the law of motion of firms across time and across space. The last building blocks is on capital structures. So we have a capitalist that owns the lands and capital structure in a given location, and we have developers that pay one period permit to develop new structure in that location. From the developer maximization problem, we determine the demand for labor in this sector that we call construction, that is going to be used to build new structure. And one minus kappa is the share of labor needed to build new structures in location N. So aggregating the decisions of all the developers in a given locations, we can compute, we can derive the aggregate law of motion of capital that is going to depend on the labor used to build new structures and the previous period stop capital, that is going to be very similar to the law of motion on capital in papers like Lucas and Prescott. So finally, we have that tariff revenues generated in location N are going to be spent by a local government on local goods. And notice that when a firm in the model, when a firm enters a location, we have no idea about where this firm comes from. So the model is agnostic about the nationalities of the firms, about the identity of the firm. So we need to assign the ownership of the local profits in the model. We do so in a very simple way. We assume that local profits are sent to a global portfolio, and each location has a fraction iota of these global profits. And we discipline this iota in order to match some moments in the data. In the model, in the paper, we have all the factor and goods market clearing conditions. That's I don't have time to show here.
Hey, Fernando, your time is up. Maybe you can just present some results very quickly.
Oh, okay. So I didn't follow the charts. This figure shows the evolution of manufacturing employment and manufacturing firms in a baseline economy with the unchanged trade policy, with increased protectionism as a consequence of the trade war. Basically, what we find is a positive effect on employment and a positive effect on the location of firms. But this positive effect is not enough to offset a declining trend in manufacturing employment and the manufacturing firms that I show you in the first figure. Aggregate welfare, as a consequence of the trade war for the United States, minus 0.18%. Slight positive gains if the other countries would have not retaliated. And finally, we find very large spatial distributional effects of trade policy. Even when we find a positive aggregate location effects and employment effects, not all the states attract firms and gain employment. In fact, we find that only a limited set of states are able to attract firms and attract employment as a consequence of the trade war. So those are the basic results. So I'm going to finish here. Thank you.
Okay, let's move on to the discussion, which is Dominic Barthelme.
Great, let me share my slides. Okay, everybody hear me and see my slides? Can you hear me?
Yes.
Okay, great.
You're good to go.
Okay, thank you. Thanks for inviting me to discuss this paper. It's a work in progress, but it's really interesting. I think it has a lot of potential. Yeah, it was a very, very interesting read. So let me briefly summarize how I saw the shape of the paper. So the paper studies the effects of trade policy on sectoral reallocation and welfare, and adds this sort of firm mobility dimension that's usually missing from these types of exercises. And the focus is on understanding the impact of the US trade war in 2018. So the model is going to be a dynamic, multi-sector, multi-region model, as in Caliendo, Parro, and Dworkin. But the innovation here is going to be, relative to that paper, is going to be to add internationally mobile firms and local capital accumulation. And similar to that paper, they're going to solve the model using dynamic hat algebra. So what are the findings? The combination of US tariffs and retaliatory tariffs are going to result in an increase in US manufacturing employment in the long run, and in US manufacturing firms, but by relatively modest amounts. Welfare is going to decline, again, modestly, primarily due to retaliation. And as Fernando briefly mentioned, there's a lot of regional heterogeneity in the impacts. So that's sort of the core findings. So yeah, I like the paper. It's well motivated, interesting questions. I think the answers are reasonable. On the technical side, there's, I think, what is potentially a far-reaching contribution, which is to, give us a way to think about firm mobility and scale effects, which I'll talk about in a second, with dynamics. And I'll talk about why I think that's potentially so important. My discussion, the rest of it's going to focus on two issues. One is, how do the modeling choices affect the conclusions? And the second is, how is the model disciplined by the data? So, we all know the effects of tariffs on welfare, reallocation, both sectoral and geographic. There's a lot of different frameworks that we can, think about these questions in. So, the paper and Fernando in his talk was very clear about describing the modeling choices, the particular way that they're going to ask this question. But I have to say, the paper as it currently stands is a little bit light on the rationale for the particular choices. And yet, there's a lot of innovation here relative to the previous literature. So it's not as though they can just say, well, we all understand the model and we're just going to apply it in this new context. I think we don't understand the model. It's a new framework of bringing a lot of new assumptions and margins. So it would be good to understand better the reasons and consequences of the particular modeling choices and to relate a little bit more analytically to the previous literature or alternative ways that this question could have been approached. So I'm gonna do a little bit of that here just to try and clarify a bit for myself and hopefully for you guys, some of the relationship to the previous literature. So we can quantify the effects of tariffs on reallocation and welfare with models of perfect competition and no domestic distortions. We have a static model as in like the recent work of Fagelbaum et al. Of course, Caliendo, Dvork, and Parro has a dynamic version. And these effects, thinking about the tariffs, in fact, the U.S. trade war, we can look at the effects in these models. And I think to generalize, for typical calibrations, this class of models tends to generate limited aggregate effects. The rationale for trade policy, if there is one, is terms of trade manipulation and some combination of inelastic demand, which is coming from the trade elasticity for typical calibrations, and flat or upward sloping factor supply curves are going to limit sectoral reallocation. Basically, U.S. manufacturing can't expand because it simply drives its own price down, and it's hard to reallocate factors potentially to the industry. Now, with more elastic demand, you can get more reallocation, but then the reallocation in welfare terms tends to be less consequential. And so there's that trade-off there. So this paper features scale effects via monopolistic competition, which has some isomorphisms to a model with, say, some form of Marshallian externalities. And I think this is a good idea. I think these are well motivated in the context of trade policy. For one, we see them in the data. Some recent work shows. Two, they're closely tied to the types of rationales that policymakers talk about when they talk about why they want to do a trade policy and protection. And in principle, they can generate much larger reallocation via downward sloping or maybe less upward sloping than they would be otherwise industry supply curves. Basically, the price index of the industry is going to decline with the scale of the industry, and that's going to offset some negative terms of trade effects or upward sloping factor supply curves. So the existing frameworks tend to be static, and so I think this dynamic extension has a lot of potential. One really nice thing about that dynamics is that you can match the data without assuming an initial steady state. Another thing, maybe more speculative, is that this sort of dynamic mechanism can give has potential as an equilibrium selection device in models with multiplicity. So I'm excited to think more about this feature. So this paper has strong scale effects. The scale elasticity is 1 over the trade elasticity, which is a consequence of the standard sort of Krugman CES formulation. And the paper also has intermediate goods. So in a standard static framework with flat labor supply curves and free entry, there would definitely be multiple equilibria in this model. However, the paper simultaneously introduces these moderating forces via 2 mechanisms: an upward sloping supply curve of firms to any particular location, right? The reason being that these entrepreneurs that manage the firms have these idiosyncratic shocks to their locational preferences. And this kind of gives the model a flavor of something between a fixed and a free entry model, right? If this parameter var epsilon that governs both the speed and of adjustment and the fixed and free entry split, if that parameter is very large, the model, firms are not willing to move in response to shocks, and it's close to a fixed entry model. As var epsilon gets very small, we're going closer to a free entry model. And the fixed entry model really, reallocation happens just as if there were no scale economies. Am I running short on time, Andre?
1 minute.
Okay. All right. Okay. So let me move on. So to summarize, we have these strong scale economies in this model, but it's difficult to increase the number of firms in a location because firms are not very willing to reallocate. And it's also difficult to increase the number of workers in the location because we have these upward sloping supply curves. And so in a model that would otherwise produce very strong responses to tariffs, these 2 features combine to limit the actual reallocation that we see relative to a model without them. And so what I'd like to see is a little bit more sort of discussion of how these mechanisms drive the conclusions and some sensitivity analyses with respect to these crucial sort of supply parameters and with respect to the scale elasticity. And the last thing that I'll say is that at the estimate of var epsilon, which is 14, that means the elasticity is 1 over 14, implies that the model is quite close to a fixed entry model. And the paper says that they don't have a comparable estimate, but there is this other paper by Suarez, Serrato, and Zidar in 2015 that I think estimates a similar parameter, and they get, if I'm reading their table correctly, about 4. So that's something to look into. But anyways, a really interesting paper. I'm hungry to know more about kind of how it relates to previous frameworks. Thank you.
Thank you, Dominic. So maybe Fernando, you can take 2 minutes to respond.
Yeah. So thank you, Dominic, for the comments. So they are great. So of course we're going to talk more later. So the possibility of multiple equilibria is something that we are studying further in the model. So you described the issue exactly right. So the starting point is an economic geography trade model. So in that model, so we know that depending on the magnitude of the agglomeration and congestion effects, there is a possibility of multiple equilibrium. But then with all these dynamics, we have more curvature in the model, given by the household's elasticity and the firm's elasticity. And potentially kind of capital could be a kind of a congestion force. And under our parameterization, this curvature is large enough in order to avoid multiple equilibrium, but it's something that we need to see with further intuition of the main results. So just briefly mentioned, so kind of the price index it's very nice to relate a price index to the theoretical literature on the location of effects of firms. So the price index basically depends on two things: the mass of firms and the price of each variety. And when you have an increase in trade policy, you have two offsetting forces. So on the one side, we observe a positive location effects that is gonna, so more firms are gonna be located in the United States, and these firms are gonna sell varieties that are not subject to trade costs, and therefore the consumers are gonna be better off. On the other side, you have a higher prices, right? From imported variety. And what we find is that this location effect is positive, but takes a lot of time. And therefore, I didn't have time to show it. So for that reason, we find that an increase in the price index in each location. Of course, I mean that we have many moving parts in the model, and we have much work to do in order to kind of clarify where the results come from. But this is kind of a very basic intuition on the main mechanisms. But thank you very much for your comments, Dominic.
Very good. Thank you, Fernando and Dominic. So let's stay on track. And the next presenter is Nitya Pandalai Nayar.
Great, thank you. So can you see my screen?
Yes.
Okay, perfect. Let me get going then. So this is joint work with Chris Boehm and Andre, and it's a paper about the trade elasticity. And so as such, it doesn't really need very much motivation, because as we all know in this audience, the trade elasticity is perhaps the central parameter in international economics. It matters both in quantitative trade models, where in many of them, it governs the size of the welfare gains from trade, but it also matters in international macro, where it disciplines the transmission of shocks across countries. Given the importance of this parameter, it is unsurprising that there are a range of approaches to estimate the parameter and a range of estimates. A large group of estimates of this parameter occur within the gravity framework. And that is basically relating the bilateral trade flows X between countries I and J in time T to the source and destination multilateral resistance terms, as we all know very well, and bilateral trade costs, phi, IJT. And these trade costs are raised to the power of theta, which is the trade elasticity that we want to estimate. The common approach when using the gravity equation to estimate the trade elasticity is to assume that these bilateral trade costs are multiplicative in tariffs and non-tariff barriers, and then to treat the tariff variation as exogenous and observed, and then estimate this equation. So we're going to argue that this is problematic, that we should be thinking carefully about what variation we use to estimate this equation. And the second thing that often happens when estimating the gravity equation is that there's typically no distinction made between the short run and the long run. So whether the tariff variation being used was the result of a tariff change that occurred a year ago versus a decade ago, for instance. Perhaps as a result, there is a very wide range of estimates that of the trade elasticity that come out of the gravity equation itself. And what we're going to do in this paper is propose a new method to estimate the trade elasticity, taking into account both that we should be careful about what variation we use to identify the trade elasticity, and also being very careful about the time horizon at which we estimate the trade elasticity. We're going to proceed in more detail. We're going to make two specific contributions. So first, we're going to think about the endogeneity of tariff changes. We're going to do this in two ways. So the first thing we're going to do is simply expand the set of fixed effects that are used in conventional gravity estimation. And we're going to show you that this actually has a big impact on the estimate of the trade elasticity, and in a very plausible way. The second thing we're going to do is propose a new instrument to isolate good variation in tariffs. And this is going to rely on the WTO's MFN, the most favored nation principle. And the idea here is that when a country changes its MFN tariff rate, this is going to affect all of its trade partners with whom it trades on MFN terms, which is going to be a treatment group, and the control group are going to be countries unaffected by this tariff change, which are going to be countries, for instance, within preferential or regional trade agreements. You might be concerned that even the initial MFN tariff rate change itself is endogenous and is the response to a specific trade partner in a specific product. And to take that into account, we're going to propose a refinement of this instrument, which is to limit the analysis to the less important trade partners for every MFN tariff change. I'll talk about that more in detail. The second contribution we're going to make is think about dynamics and the time horizon of estimation carefully. We're going to make an explicit distinction between the short run elasticity relevant for international macro models and the long run elasticity relevant for steady state trade models, and provide internally consistent estimates in multiple horizons. And to do this, we're going to use local projections. These are commonly used in macro. In terms of quantification, I won't have time to talk about this today. There's a lot in the paper. I'm going to briefly mention the implications of our elasticities for the gains from trade, which is the natural long-run quantification. But we also in the paper show how the time path of elasticity that we estimate can discipline the speed of adjustment in dynamic trade models. Okay, so a brief summary of our results. We find that the trade elasticities are significantly different across horizons, and they increase smoothly over time. The short run elasticity a year after impact is about 0.75, and the long run elasticity, which is at about 7 to 10 years, appears to be about 2. So this is a tariff exclusive elasticity, and these numbers are much lower than even the lower end of the range of estimates commonly seen before. And we're going to show you that these higher conventional wisdom numbers are simply because of not controlling for omitted variables. So this is omitted variables bias. This is not because of our instrument. In fact, our instrument actually delivers estimates that are larger than OLS at all horizons. And so I'm going to walk through this pretty carefully. The implications, naturally, a low elasticity implies larger welfare gains from trade. So the welfare gains from trade are about 5 to 6 times higher than under conventional values with our estimates. And the time path we estimate also implies that there's substantial curvature in the adjustment cost to export. So let me briefly define what I mean by horizon specific trade elasticity. And this is simply going to be the epsilon h, which is the log change in bilateral trade flows in a particular product over h horizons. So delta h is going to be xt plus h minus xt minus 1, divided by the change in trade costs, and making the standard multiplicative assumption. This is the same as the change in trade flows divided by the change in tariffs. The long run elasticity then is the limit as h tends to infinity of this object. And this is what we're going to be interested in estimating. Our actual estimating equation is going to be a local projections estimating equation. And I'm going to go through this in steps. So we're going to estimate local projections both for trade volumes and for tariffs. So that to begin with, we're going to estimate our trade volumes equation, which is regressing the h period change in trade flows in a 6-digit product on an initial change in tariffs. So this is delta naught. So it's an initial shock in tariffs with a bunch of fixed effects. And if that initial shock in tariffs was just a one-off change, nothing else ever happened, then this beta hx, the coefficient on this on the tariffs would be my horizon h trade elasticity. But tariff changes can be autocorrelated. They could be staggered, and we're going to show in the data that in fact they are autocorrelated. And so to take this into account, we also estimate local projections equations for tariffs. This amounts to regressing the h period change in tariffs on the initial tariff shock to see how much of that initial tariff impulse survives over h periods. And we need to do this because if you treat just an initial tariff change as all that's happening and use beta hx as your trade elasticity, you could get a biased estimate because, for instance, suppose the initial tariff change predicts a future tariff change, and you see over h periods a very large response of trade flows without taking into account that future tariff change, you might estimate a very high trade elasticity, which would be incorrect because the actual change in tariffs was larger than what you estimate with the initial tariff change. So when we do this, the trade elasticity horizon h is going to be the ratio of beta hx divided by beta h tau. And of course, this allows for the fact that all initial tariff changes are permanent because then this coefficient would simply be 1. Okay, a word about the fixed effects. We're going to include the standard multilateral resistance fixed effects, which are commonly used in gravity estimation now. But we're also going to introduce a bilateral product-specific fixed effect. Okay, and this is going to be very important. We introduce this fixed effect to mitigate omitted variables bias. And what this does is in a standard log levels gravity specification, this would take out any bilateral variation in taste parameters or in the non-tariff trade cost that is potentially correlated both with tariffs and with trade flows. Okay, so you could imagine, for instance, a situation where there's a high preference bilaterally, a high taste parameter, which results in both low tariffs and high trade flows and leads to a biased estimate of the trade elasticity. Okay, and we're going to show you that this additional fixed effect matters a lot for the estimates of the trade elasticity, even if you don't particularly want to use our instrument. Okay, so even in conventional gravity. So now this is the approach we have to estimation. So this is how we're going to estimate elasticity at different horizons. As is common in macro, we can actually combine these into a single step. This is common in the government multiplier literature, for instance, the fiscal multiplier literature. And we can estimate the trade elasticity in a single step at every horizon. I'm going to call, we can do this, and we're going to call this our OLS estimate. Because here we're still using all possible changes in tariffs in the data. We can also then argue that even conditioned on the fixed effects, we need to still think carefully about what variation tariffs we're using. And we can instead use some plausibly exogenous variation in tariffs and use the same estimation procedure and obtain our IV estimates. Okay, and the details on the paper, so I can't go into details further now. I'm assuming I have 5 minutes since I see the chat flashing. So I'm going to argue that tariff changes are likely endogenous, and you want to be careful about what tariff variation you use. And in fact, there's a huge literature in trade policy that is precisely making this case for me, so I'm not going to spend much time on it. But you can think of a number of omitted factors, like business cycles, changes in governments, for instance, that lead to endogenous tariffs. You can also think of reverse causality, for instance, because of lobbying. So the implication is that we need to think very carefully about the fixed effects. We want to take out a destination product time variation for sure, possibly even partner-specific variation, but even with the fixed effects, the residual tariff variation could still be endogenous. But of course, this is problematic because it's very hard to find an exogenous shock to tariffs. So again, what we're going to do is propose a new instrument that can help with this concern. And this is based on the WTO MFN principle, which implies that, which means that countries, when they apply an MFN tariff, they apply that same MFN tariff to all trade partners with whom they trade with on MFN terms. And so essentially, our instrument is going to select initial tariff changes where the tariff change is an MFN tariff change between periods T-1 and T, and it's going to affect trade partners that are bound by MFN tariffs in both periods, and in the baseline are plausibly not trade partners that influence that MFN tariff change. By this, we mean we're going to exclude the top 10 trade partners of a country, either in terms of aggregate or product level trade flows, and we can vary this. So the residual, the idea here is that the countries, the US changes its tariffs, its MFN tariffs because of concerns about China, but these MFN tariffs are also going to affect Hungary, and we can look at the response of the trade flows from Hungary compared to a control group, which is, for instance, Canada or Mexico, and identify the trade elasticity in that way. So let me show you the results very briefly. So here are our trade elasticity estimates. The red is OLS and the blue is IV. And you can see that they're small on impact. So year 1 is our impact elasticity. And then they build over time. The IV estimates are larger than the OLS at all horizons. Okay, and the OLS is more comparable to standard gravity. So you can see that our instrument is actually increasing the estimates, if anything. The OLS estimates are very small. And they stabilize at around 2 in the long run. We also do this in our baseline is a single elasticity across all products, but we can also do this with sectoral variation. We see a similar path, but obviously there's heterogeneity across sectors. But let me spend my last minute talking really about why we get such low numbers. Okay, and so the panel here, this table here, I want to focus on panel A. What I'm doing here is running a conventional log levels OLS gravity estimation on our data. Okay, and column 3 in particular is the conventional log levels OLS estimation of the trade elasticity using the standard multilateral resistance fixed effects. And you can see that we get an estimate of about 6.7, which is well in line with conventional wisdom estimates on our data. So there's nothing specific about our data that we're getting the low elasticities. Columns 4 and 5 simply change the fixed effects. So column 4 includes only the bilateral fixed effect instead of the multilateral resistance terms, and column 5 includes both the bilateral fixed effect and the multilateral resistance terms, And you can see that this has a huge impact on the estimate of the trade elasticity, even in conventional gravity estimation. In fact, in column 5, the elasticity falls to 1, okay? If we difference, we naturally take out, so this is panel B, when we difference the conventional gravity, we take out the bilateral fixed effect in levels, and you can see that across all columns, the elasticity falls dramatically. And then once we add in our instrument and we get to column 5, we actually push up the trade elasticity relative to the conventional gravity estimation. Okay, so really what is happening for the low estimate is simply omitted variables bias, conditional on taking, on mitigating that, our IV is actually increasing the estimate of the trade elasticity. Okay, so I'm out of time, so I just want to show you very, in the last second, that if you use our trade elasticity, which when we take into account, we estimate tariff exclusive elasticity and the elasticity relevant for welfare is tariff inclusive. That's about 1. You can see the gains from trade are very large relative to, say, a conventional wisdom estimate of 5. This also means naturally that the losses from decreasing trade openness are also larger. Okay, so that's it. I'm going to wrap up. I'm not going to talk about the model. We have a model in the paper, but really what we're doing in this paper is trying to provide new estimates of trade elasticities, thinking very carefully both about causality and about the time horizon of estimation. And what we're finding is that the short run and the long run elasticities are low, and the long run in particular is lower than what is commonly used in the literature. Thank you.
Thank you, Nitya. The discussant is Joe Steinberg.
Okay, can you guys hear me and see my screen okay?
Yes.
Cool. Okay, so thanks a lot, Andre, for inviting me. This is a really fun paper to read. It really kind of prompts a lot of stuff to think about. So I'm going to try to get into that as well as to provide some comments on the paper itself. So the basic question of the paper, I think, is really straightforward, and it's self-evidently important, as Nitya said. It's basically just, what is the trade elasticity at different time horizons? The answer, to make a long story very short, less than 1 in the short run, about 3/4, roughly 2 in the long run. Along the way towards getting to these numbers, the paper makes a number of pretty important methodological contributions. So number 1, as Nitya said, omitted variables. Once you include bilateral fixed effects, as well as the traditional multilateral fixed effects, that lowers trade elasticity estimates substantially. Number 2, reverse causality, thinking really carefully about, what variation in tariffs should we use to estimate these elasticities? What variation in tariffs really is exogenous? And so I think it's pretty cool. It's basically thinking about what happens when a large country, say the United States, reduces its MFN tariff schedule, and thinking about how that change affects just small exporters to the United States that are unlikely, at least really unlikely to be responsible for the United States making that decision to cut its MFN tariffs. Number 3, a new method for thinking about carefully how to estimate these elasticities dynamically using local projections, basically taking into account the fact that tariffs might follow some, non-trivial dynamics following some initial reform. We need to take that into account as well. And finally, the model in this paper is not new, and Nitya didn't have time to go into it. But what I really like about this is that basically the authors are showing some, theoretical grounding for their local projections framework. Basically showing how any, of the canonical exporter dynamics models, Krugman or maybe even Costas's job market paper, give rise to the main estimating equation that's used in this paper, which I think is really cool. So broadly, my comments are as follows. Number 1, this is a really important issue. The trade elasticity is the most important parameter in determining both how trade flows will respond to a change in trade costs and also in quantifying welfare. So it's really important to understand what the true trade elasticity is, and there's a lot of disagreement. And I think also a lot of the contemporary issues that we are analyzing today, in this session and more broadly as a field, are inherently dynamic in nature. And so getting a handle on how trade evolves over time in response to changes in trade costs is really important. This paper is an extremely comprehensive attempt at addressing all of this stuff, pushes the methodological frontier forward in a variety of ways. Really broadly, I'd like to see a tighter connection to other studies of trade elasticity dynamics. I think this paper makes a strong effort to connect to kind of static estimates of trade elasticities, long run estimates. But there are some other papers that try to estimate trade elasticities in a dynamic context. I'd like to see some effort in comparing to that. The main question that this paper really brings to mind here is why. What are the economic intuition or economic explanation for the bilateral fixed effects? What variables are being omitted? And what's going on with the IV as well. And finally, I'll just very briefly provide one alternative micro foundation that helps rationalize the very low short-run elasticities that this paper gets. So first comment, I'd like to see some more comparison to other studies of trade elasticity dynamics. There are a number of papers that have done this. Certainly the ones in this table are not all of them. This is just a couple of examples. And I think there are a wide range of long-run numbers here. But there is a fairly broad consensus that short-run elasticities are pretty low relative to long-run elasticities. It's difficult to compare the author's results to these results just because both the scope in terms of the data, as well as the methods are quite different. But it would be really nice to see, for example, how does local projections compare to other dynamic, how does local projections compare to, other dynamic methods that are used? How do these bilateral fixed effects and the IV alter the estimates from, other dynamic methods that are used out there? How does the level of aggregation matter? I think it'd be important. It would be nice to kind of more directly compare to these other estimates out there. More importantly, though, what are the economics behind the main results? And I think this slide is probably the one that I'm the most interested in understanding. This is not a criticism, it's more a call to arms. I think there's, this paper prompts us to need to go out and try to understand this stuff. So why do bilateral fixed effects lower trade elasticities? That amounts to asking, why are bilateral taste shocks high when tariffs are low, or why are bilateral non-tariff barriers low when tariffs are low? And I think it's important to understand this because standard, fixed effects in most gravity equations have clear economic interpretations. They capture, real GDP, prices. But as far as I can tell, these bilateral fixed effects don't really have a standard economic interpretation. Certainly, they don't in a standard model, as I'll mention in just a minute. There's some potential explanations. Maybe it has something to do with pricing to market. Another potential explanation is endogenous transportation costs. There's a paper written by a friend of mine on this issue that I think could help rationalize this as well. But very briefly, the quantitative implications of this are really significant. They push down trade elasticity estimates a ton. And so I think it's really important to sort out what's going on here. What kind of models do we actually need to use to understand how trade responds to changes in trade policy? I'd also like to get deeper into the economics of the IV. I think the authors do propose a pretty solid potential explanation to this, reverse causality. I'd like to know, number one, do we actually see reverse causality in the data? And that's something that you can go out and test. I'm a little bit skeptical that, for example, 10 years out, trade could be causing tariff changes today, but maybe it could be. Regardless, I think we should check. There is another potential explanation for what's going on here, particularly the difference between minor and major trade partners, which is that in the data, minor destinations do actually tend to have higher trade elasticities. And this seems to be driven by larger firm level responses, both on the extensive margin, Carter Mix has a paper on this, as well as on the firm level intensive margin in kind of the Archilochus context, as I have some work on this as well. And this is in fact consistent with what the authors have shown in one of their sensitivity analyses, where even using this IV, if you just look at all trade partners rather than just the small ones, you get lower trade elasticities. Very briefly, I wanted to know whether some of this stuff could be just coming from perhaps general equilibrium effects. is there something that I'm missing where we could just be getting, these results in a standard model? And the answer is no. I just kind of rigged up a very simple Armington model with a bunch of asymmetric countries with random labor endowments, random tariffs, some of which are in the WTO and apply MFN tariffs to all other WTO countries. Some are in a free trade agreement, and then there's some non-WTO countries as well, kind of like in the author's analysis. And simulating, the kinds of things that the authors are looking at, tariff cuts by non-WTO members, MFN tariff cuts by WTO members. What you find is that, bilateral fixed effects do nothing. This MFN IV does nothing. And this is probably not that surprising, but the point of this is simply to say, we need to understand what the economics, behind these results are. I think that that's really important. Finally, very last comment. The authors point out that this really low short-run elasticity is incompatible with a lot of the the standard models that we see out there, and the reason for that is that constant markup environments, Krugman, Mellitz, whatever, they require that the elasticity of substitution between varieties of goods is greater than 1, right? And in the short run, in most of these models, that's precisely what the trade elasticity is. An alternative is simply, what about convex adjustment cost? This is something that's been seen in the literature in a number of places. And what's different about doing it this way is that you get a long run elasticity that's equal to the elasticity of substitution across goods, and a short run elasticity that's less than that. And in fact, you can calibrate the size of these adjustment costs to get, whatever short run elasticity you'd like. So I conjecture that this framework would also give rise to the same kind of estimating equation. It'd be nice to show that formally. Another, finally, simpler alternative is, you can have an Armington elasticity of substitution between stuff from different countries that's less than 1, and an elasticity of substitution between varieties of goods from the same country that's greater than 1. And that will also kind of get you what you need as well. Okay, I'm out of time. So thanks a lot. This was really interesting. It, really a lot to think about. I'm looking forward to digging into it further. Thanks a lot.
Thank you, Joe. Nitya, you want to take a stab at responding?
Sounds good. Thank you so much for the great discussion. That was really super useful for us. Very briefly, let me touch on a few of the things you mentioned. So that, yes, of course, we are comparing, and we can more exhaustively compare our estimates to other papers. I think the ones you mentioned, we're citing all of them, if I'm not wrong. But let me talk more about, so naturally what you're saying, understanding the economic implications of what we're finding is super important. And this is opening for us many future papers, hopefully, right? So the things that we have found. Why do we think we need the omitted variables, the bilateral fixed effect? So very simply, when you have, even in very standard models, if you have a preference parameter that is bilateral on any product, that is going to multiply the tariff, the iceberg trade cost. Okay, and as soon as you have that, if that is correlated with the iceberg trade cost or with the tariff, then the model itself is going to tell you need this bilateral fixed effect. Similarly, when I say the iceberg trade cost is multiplicative in tariffs and non-tariff barriers, again, if those non-tariff barriers and tariffs move in the same direction, the model tells you need a bilateral fixed effect. So that's kind of our theoretical motivation for why we should have these. In terms of the IV, you're right that the estimates are low when we include all countries. Of course, we are, our sample, I want to just clarify for the audience, is not small countries, right? So you've seen this in the paper. A country, the US might be an important trade partner for some countries, but it's not necessarily in the top 10 for all countries. So, we have the overlap in our treatment and control group is pretty good. So we're using large countries actually in the analysis, but I agree that we have to think about why the IV estimates are actually larger than the OLS estimates. The third point about the short-run puzzle is really interesting. You proposed that. We've actually heard this from Droz and Nozal as well. And so something that we actually want to explore to see whether we can use this to rationalize our short-run elasticity. But I think, yeah, I think we do think that the omitted variables bias is plausible in the context of standard models. Yes, I think that's right. No, then there's some other things that I can talk to you about later when we talk about it. Thank you.
Great. So we actually have a couple of minutes, and I see there's a question from Mary Amiti. Mary, do you want to unmute and ask it?
Hi, yes. So I have two questions. One is on the omitted variable issue. So yes, it is plausible that adding those fixed effects could be absorbing, accounting for some omitted variable bias, but it could also be just absorbing part of the trade elasticity. And so I was just wondering if there was some way that you could, provide some more convincing evidence that it is actually omitted variable bias. And the second question I had was about the zeros and potentially selection bias. And I would imagine that that would be a bigger issue as you go out, longer horizons. So just in terms of how that could be impacting the different elasticities you're getting over different time horizons.
Thank you. So about the omitted variables bias, so the way I'm going to, I think the most intuitive is perhaps to give you an example of a case where it's very clear that you need it. So if you think about the US and North Korea, right? The US has very high tariffs on North Korea and very low imports from North Korea. But this is not because of the high tariffs. This is a preference parameter, which clearly needs to be accounted for in estimating the trade elasticity. So if you just used these two countries and you estimate the trade elasticity, you would get a very high trade elasticity, which is clearly because of omitted variables bias. So that's the intuition for what we're doing. We can theoretically found it. We could also look at the actual fixed effects and see what project them on, say, preference parameter, on things that capture preferences, for instance. If possible. But of course, it's not just preferences, it's also non-tariff barriers, right? So these are all together, and transport costs, as Joe pointed out. These are all in those fixed effects. But I think that not accounting for them is more problematic than actually having them in the estimate. In terms of the zeros, that's a great question. So we actually, everything I showed you is an intensive margin. You're absolutely right. This is relying on actual trade flows existing in each of those horizons. But in the paper, we actually also do take into account zeros. And we do it in two different ways. So the first is we allow for basically all zeros. And this actually leads to low elasticity estimates. So the reason for that is that there are a lot of zeros that just stay zero forever because, for instance, Russia is never going to export mangoes to the UK. Okay, so regardless of what the MFN tariff variation is, the zero just stays zero. Okay, so this actually leads to even lower elasticity estimate than you'd get otherwise. The second is the case that is more relevant, for instance, for a dynamic trade model, which is where we condition on a trade flow actually existing at one point in the difference. So a zero becoming positive or a positive becoming zero, that leads to elasticity estimates that are about the same, maybe a little bit higher, a little bit lower, depending on specification. But we do actually do this in the paper. I didn't show it today.
Can I add one point to this? Because I think there was a concern that this bilateral fixed effect also absorbs part of the trade elasticity. And so that's why we wrote down a model to convince ourselves that that's not the case. We have a model, which we didn't show in this presentation. But this model has a well-defined trade elasticity at all horizons. It also gives us the estimating equation. And so with that in mind, and so limiting cases send us back to, say, a static trade model. And so we are quite convinced that that we're not absorbing part of the trade elasticity in this bilateral fixed effect. But if you have sort of concrete mechanisms in mind, then of course we'd like to hear that.
Very good. So let's move on to the next paper to stay at least somewhat on track. Bruno, you're presenting?
Yes. Let me share my screen. To be able to see my slides?
Yes.
Excellent. Right, so thank you very much to Andrei for putting together the session, and also to Giorgio for quickly moving us to another virtual location. So today I'm going to be presenting some new work with Enrico and Romain, who are also joining us for this session. So the research question that we want to address is what barriers hinder cross-border investment? So this is going to be a trade about foreign investment rather than trade. And we want to ask if there are some barriers, what is their economic cost? So what do we do to address this question? We first do some theory. We first propose a new multi-country dynamic general equilibrium model of foreign investment. And this model produces a structural gravity equation for bilateral investment position. Next, we do some empirics. We estimate various flavors of this gravity equation. Our benchmark specification has 4 explanatory variables that captures barriers. We have capital controls, geographic distance, institutional distance, and cultural distance. I'm going to define them in a bit. And finally, we take our model to the data. We find that our model predicts out of sample a significant home bias. So that's a realistic feature of the model. And it also produces higher returns to capital in emerging markets. So that's another realistic feature. Finally, we use our model to do some counterfactuals. And so we ask, if we were to remove these barriers, how much would we gain in terms of world GDP? We find that the capital misallocation induced by these 4 barriers leads to a cumulative about 9% in world GDP loss. And even more importantly, we find that this capital misallocation has a very important implication in terms of cross-country inequality. Now, this paper, of course, relates to a large literature in both international finance and trade on gravity. And it also relates to the macro literature on capital misallocation. The way that we see ourselves contributing to these many literatures is by providing sort of like the first multi-country structural gravity model of foreign investment broadly defined. Why do we need this new model? It allows us to do something new, which is analyze capital misallocation across country and relate this capital misallocation to various geopolitical factors. Okay, so without further ado, let me get straight into the theory. So in our model, there are n countries, and we're going to use the subscript I to denote the country that uses the capital, the destination country, and we use the subscript J to denote the supplying country, that is the investor country. Now, each country has a representative firm that produces a homogeneous tradable numeraire good that can be either consumed or reinvested as next period capital. Each country also has a fixed stock of labor that is immobile. So capital can move across countries, but labor cannot. We assume that each country uses a Cobb-Douglas production function with country-specific elasticities. And this is the sort of the non-standard tweak. We assume the production takes place in plants. We use X to index these plants. And these plants hold a fixed amount of capital. They are costless to build and decommission. So what that means in practice is that basically plants for us are simply a discrete version of the capital stock. Now, consumption and saving. So in each country, every period, a continuum of agents indexed by Z between 0 and 1 is born and lives for 2 periods. So this is an overlapping generation model. We denote the consumption of agent Z at time t as CT of Z, and we assume that these agents hold intertemporal log utility. Now, each agent Z is endowed with units of labor that are inelastically supplied. When they're young, in period 1, they work and invest part of their labor earnings, which are given by WL. They can invest abroad. In the second period, when they're old, they leave off their capital returns. And in this model, we are going to look at a steady state equilibrium. Now, here's the interesting part, which is how these agents allocate their investments across different countries. Now, the agents are atomistic. And so each agent invests their atom of capital in one plant located anywhere in the world, and they invest it in the plant that offers the highest subjective return. We call big R the subjective return, and notice that this big R is a plant investor specific, so it's XZ variable. Now, why is this return subjective? It's subjective because asset markets are imperfectly intermediated by an agent that collects a net foreign investment fee, which we call tau, also variable at the XZ level. So the subjective return is related to the objective return on capital by this fee. So big R, the subjective return is equal to the objective return, small r, in country I where plant X is located, times this multiplicative investment fee tau. We're going to put some structure on this investment fee tau. We're going to assume that it's made up of 4 linear components. The first one is a multidimensional vector of distances between the investor country where the investor Z is located, that country J, and country I where the plant X is located. And there is going to be a vector of same elasticities beta. The second component, which we call phi, is related to capital controls. It captures capital account openness between I and J, so captures both inflow restrictions at the level of country I as well as outflow restrictions at the level of country J. The third component is at the level of plant and investor, and we call it Xi, and we assume that this is drawn from an extreme value type 1 distribution. The fourth and last component, which we call big T, this is simply a rebate that makes sure that the intermediating agent makes it 0 profits. So we solve the individual investor problem, and we allocate it at the level of country J, the investor country, and we obtain sigma IT. These are the portfolio share. It tells how much of the capital saved in country J is invested in country I, and it has a very intuitive functional form. It depends positively on the degree of capital account openness between country I and J, that's phi. Depends positively on the rate of return in country I. And it also depends positively on the size of country I as captured by its capital stock, and it depends negatively on this multi-dimensional vector of distances. Negatively because beta here is negative. Now, we can also rearrange the previous equation for sigma, and to obtain the bilateral investment positions. So AIJ here is the I assets owned by investors in country J. So this is in levels, and we find that they obey a gravity equation, where the asset position is proportional to both the GDP of country I and country J, and it's inversely proportional to this multidimensional distance metric. Okay, so let's talk about the empirics. So to estimate this model, to estimate this gravity equation, we try and use the best available data, and we use IMF data on foreign direct and portfolio investment that has been restated from a residency to a nationality basis to account for the presence of offshore investment in financing vehicles. It has been done by these 2 very nice papers. And so basically, this data accounts for the presence of tax havens. Now, we have various explanatory variables. We have a geographic distance. This is simply the population-weighted geodesic distance between countries. We have a measure of cultural distance, which is based on the World Values Survey. We construct a measure of institutional distance that captures the presence of a common currency, common legal origin, as well as the presence of a bilateral tax treaty. We also use a new measure of capital controls recently developed by Fernandez and co-authors, which is based on the IMF's database of capital account measures, ARIER. And we use the last one, this measure of capital controls, to parameterize phi. So phi is related to this measure of capital controls by a semi-elasticity called beta phi. Now, all we need to take our model to the data are estimates for these semi-elasticities beta and beta phi, and we get them using regression analysis. Everything else is either we get from the data or is identified. So we use both OLS as well as pseudo-Poisson regression to account for zeros in the data. We also run regressions with various control variables, accounting for various historical ties and geographical ties. And we also have an instrumental variable specification to account for the potential endogeneity of cultural and institutional distance. Okay, so we then can take our model to the data, and luckily, even after we've used all of these variables, we still can cover about 93% of world GDP in 2017. So we have fairly good coverage. Okay, so the first realistic feature of our model is that it produces this negative correlation between returns to capital and the level of development as captured by GDP per employee. So that's nice. And the other particularly realistic feature is home bias. So what you're looking at here is the matrix of sigmas. So these are the portfolio shares. And it's important to note that in the gravity equation that we estimate, we do not observe, for the IMF data, we do not observe domestic investments, which here is represented by the diagonal elements. So this comes from the model. This matrix comes from the model. And so these diagonal elements, the domestic investment is completely out of sample, so it's non-targeted. And our model is able to replicate the home bias that has been observed in other papers. Okay, so finally we use our model to do counterfactuals, and we ask if we were to remove these 4 barriers, how much world GDP would we be able to recover? And the answer is about 9 percentage points. Of course, we do other counterfactuals in the paper. We try and reintroduce all of these barriers individually to try and compute their marginal effects. We find they have more or less similar magnitudes. But here's perhaps the most interesting result, and it's the country heterogeneity. What we find is that when we remove these barriers and let capital reallocate across countries, it tends to redistribute itself in a much more equal way across countries. So here you're looking at the distribution across countries of capital per employee in logs. And the light blue area is the observed distorted equilibrium, while the dotted line is the zero gravity world where we have removed all of these barriers. You can see we see a shift to the right, but especially we see a large reduction in dispersion. And we observe a similar effect in terms of GDP per employee. So again, a shift to the right and a drastic reduction in dispersion. Now, why does this happen? The reason this happens is that when we go and look at which countries get reallocated more capital and which countries lose capital when we remove these barriers, we find that the countries that gain capital tend to be countries that start from a low level of capital per employee and a very low level of GDP per employee. Here you can see the relation between the change in log capital per employee and the baseline level of development. And you can see this very strong negative relation. So the countries that lose capital tend to be the richer countries. So and this is the reason why you see this drastic reduction in inequality occurring when we remove these barriers. So I guess I'm almost out of time, so let me quickly wrap up. So in this paper, we have presented a new OLG model of international investment that leads to a structural gravity equation for bilateral investment flows. We have estimated this gravity equation using some new restated data on FDI and FPI, and our results suggest that cultural, geographic, and institutional barriers exert a major influence on the networking of international investment positions. We find that by removing the capital misallocation resulting from these barriers, there are substantial gains in world GDP, about 9 percentage points. And finally, we find a highly heterogeneous effect across countries with significant implication for cross-country inequality. And with that, I'm probably out of time. So thank you for the attention. I'm yielding the floor back to Andrei.
Very good. Thank you, Bruno. The discussant is Julian Di Giovanni.
Stop sharing. I don't see, for a second, I don't see my controls. topology.
Very good. Can you can you see my screen?
I can see you
No.
for now.
You can see me. Okay. 1 second. Sorry about that. Better?
Yes.
Okay.
Here you go.
Perfect. Well, thank you very much for having me here to discuss this paper. Given my new employer, just the usual disclaimer. Very good. So just to begin, just kind of think what this, the big question in this paper is one that's been puzzling macroeconomists for a long, long time. What determines capital allocation across countries? And in particular, if you think of a canonical macro model, one would imagine that capital flows across countries to equalize returns. Right? As we know, it's been studied for decades. This tends to fail in the data rather brutally. And there's a host of explanations for why this might be the case. There might be differences in additional factor endowments across countries, for example, human capital, domestic distortions of market imperfections, poor institutions, differences in financial development, etc. And of course, and where this paper is taking off from, there's also potential international barriers to capital flows. And so as Bruno explained, and just to give a brief overview, this paper makes several interesting contributions. First, it constructs a new multi-country OLG model that embeds both investor heterogeneity and frictions across onboard investment. And it's a slick model. It allows you to take the model to the data in a very standard gravity model that they apply to some recent data, both for foreign direct investment flows as well as foreign portfolio investment, not flows, but asset stocks. And their core variables they're interested are looking at are bilateral distance measures, both geographic, cultural, and institutional, as well as a measure of capital controls. And I put bilateral in parentheses, and I'll return to this later on. And overall, as all gravity models, it fits the data well. The one weakness are capital controls don't seem to do super well in explaining, kind of barriers to FDI. And again, I'll touch on this later on. Now, what's nice then is you can take these gravity estimates and feed them into counterfactuals in order to calculate world GDP losses as well as cross-country differences arising from these bilateral frictions. Overall, the estimates help the model match data quite well on capital allocation as well as cross-country return differentials, where they take great care of using other authors' estimates for these, so it's out of sample. Overall, the impact of international frictions are large. Where kind of one number that Bruno mentioned, the measured barriers imply a world GDP loss of up to 9% relative to a frictionless world. So overall, a nice paper with interesting results. So to kind of kick things off, my general comment question is that the paper is quite ambitious and in some sense is trying to marry two different literatures. And this left me with a basic question I'll come back to over and over again on some levels. How important is the relative contribution of gravity relative to country-specific fundamentals policies, thinking about global misallocation of capital? On the one hand, you could think about gravity applying to gross flows, for example, gross equity flows. On the other hand, when you're thinking about allocation, both domestically or internationally, we want to think about in some sense net flows. For example, Lucas's classic question: why doesn't capital flow from rich to poor countries? Okay, and what this paper is trying to do is bring all these ideas together, but then it kind of raises questions that I'll touch on both in terms of data, estimation, and just how to kind of think about the quantitative exercise. So I'm going to follow up with some kind of few comments, quibbles really on the model, a little bit more in depth on data estimation, and some issues on the quantitative exercise that would be great to think about a bit more. So my basic comment on the model: very nice framework, maps the regression of quantitative exercise nicely. As I said, some quibbles where I got a bit lost. So in solving the model, they treat the final price as a numerator on each country, but then it was making me think, what about relative prices across countries, right? They don't take a stand on this, at least not that I could see. Of course, this is taken into account in the data where everything's treated in US dollars, but what is the assumption in the model that allows them to do this, and how does this map to the empirics and the calibration? This is a session on trade, so maybe it's a bit of a cheap shot, but there's no frictions in goods trade. They do control it in their regressions to some degree with empirical measures of empirical trade costs, but just in terms of a matter of interpretation for the distance variables, right? This might not be just capturing, frictions vis-a-vis capital flows, but also trade that goes with this. Okay, so again, there's famous papers by, for example, Upselt and Rogoff, like the trade puzzle paper. Just it's more for context. And finally, everything's derived in terms of efficiency vis-a-vis GDP. Well, how different are the results for actual welfare? And they give some intuition on this, but I was just thinking a bit more in depth about this, given that it's the log utility and the OLG set. So in terms of comments and data, let's just look at their gravity equation. The investment from J to I at time t. It's a function of a lot of fixed effects, some non-time varying distance measures, capital controls, and an error term. And so they're using more recent data, and they're using a panel measure, and they're using data over time. And the kind of first question is this good to measure steady state FDI and FPI? Right? Ultimately, they're estimating deviations around some period average, so perhaps capturing more of a volatility of capital flows. But moreover, over this period, countries have experienced boom-bust cycles, perhaps less frequent than pre-global financial crisis. But there's also been a post-GFC transition away from cross-border bank lending to portfolio flows, including debt, as well as policies enacted to change the composition of capital flows. So just, maybe one way to kind of avoid all these questions, and also given that they're using instruments that don't vary with time, why not just run a cross-sectional regression? Particularly since capital controls is the only key variable that varies with time. Second, the capital controlled measure in itself is not really bilateral. And it's a sum of countries one country's inflow barriers versus another country's outflow barriers. So one question that kind of comes to mind immediately is that they're imposing some symmetry on the impact of inflows and outflows from capital controls. How good assumption is this? Arguably, yes, the IMF, they might not think it's a great one. Moreover, how do these capital controls vary over time? There's potential endogeneity of the adoption of controls over time, which is not addressed in the IB strategy. Indeed, besides capital controls, since 2009, there's plenty of microprudential policies that have been put into place across emerging markets, in part to deal with volatility of capital flows. Okay, and indeed, you only see this showing up for portfolio flows as variable rather than FDI. So there's other variables. I think I've used them a long time ago in some papers. You can exploit data on bilateral investment treaties or trade agreements to potentially kind of enrich the analysis. Okay? Slightly more problematic, and that what really kind of gets the heart of what I'm trying to think about, how to take everything together is, what else do cultural and institutional distance measures correlate to? For example, do they correlate to the similarities of countries' financial market size, or development overall? And this matters for the interpretation of results, as well as the policy implications they're trying to kind of take away from the model vis-a-vis kind of bilateral frictions. Okay? And this gets back to this notion of net versus gross flows I touched upon at the beginning. Okay. Some other kind of little things on estimation, which are easy enough to fix, but also important for interpretation. Gravity model fits well, but how much of the fit is explained by distance and capital control variables? I just couldn't figure this out from the basic statistics or R-squares presented. Using the Poisson regression is a good check. It was unclear to me whether it was applied to all countries, including those without equity markets, which would be a little weird to think about. Also, how does the model fit equal, across different country groups? For example, advanced versus advanced emerging markets. Okay, and this goes back to gross versus net flows. Okay, and finally, just something I picked up was the absolute size of the instrumented distance coefficients for both institutional and cultural tend to increase relative to the OLS estimates. And I was wondering, why might this be the case? Is it something about measurement error? Is there something going along that's picking up other kind of unobserved variables using the instrument that I've touched on in the previous slide that might matter? Okay. All right, so I think we're doing okay with time, so I'm going a bit fast. But finally, the model fit and counterfactuals. Again, it would be great. They fit everything wonderfully out of sample, but they're also feeding a lot of data into their calibration. Observed measures of TFP, etc. So, like the gravity estimates, it would be good to know what the contribution of the gravity variables are in explaining the overall fit, as well as their out of sample predictions of home bias, return differentials, relative to other variables that are included in the calibration. Okay. Next, is 8.8% a big number or not? It really does seem quite large, but how would this compare, for example, relative to improving all countries' institutions to the same quality of Germany's, for example? What would this imply about capital relocation? This is, outside the model. The paper is still, I think, very new, so one could think about running some robustness checks and maybe even kind of build up on the model a bit more. But rather than, say, running gravity with fixed effects, which is the theoretically correct way of doing it, let's just take a step back and maybe just see some OLS results where, rather than, putting in these fixed effects for I and J, feed in some country characteristics. such as the quality of institutions. I'm a little concerned that these guys doing so might be correlated to the distance, the cultural institutional difference. Hopefully not. If not, then I'd be worried about the fixed effect regressions, and I'm guessing you'd still show, get something interesting showing up here. Again, not as parsimonious as the fixed effects regressions, but it would allow for perhaps adding a simple cost of investing in country I into the model, and then rerunning some counterfactuals and just kind of trying to figure out, is it really bilateral frictions that matter, or the estimation, the way the model's set up, implicitly kind of picking up differences across countries, rather, that might matter quite a lot. Okay. And finally, and back to kind of the theme of today's session, why not extend the model to trade costs? I imagine it would actually be quite simple to put some iceberg costs in, and given that you're already feeding some information into the a measure of empirical trade costs into the regressions, you could then maybe run some more counterfactuals with that. So that's my alarm. It says I couldn't see the chat, and I think I'm over on time. So again, I think it was a really well-crafted paper. It made me think a lot. Lots of interesting results, and I'm looking forward to seeing some future iterations of this work and other ideas that they had in the paper. Thank you very much.
Thank you, Julian. Bruno, maybe you can take a couple of minutes to respond.
Yeah, sure. No, thanks so much, Julian. This is extremely constructed. These are all great suggestions. Some of them we're already thinking about. So you mentioned en passant the capital controlled variable, not explaining FDI very well. We're thinking, you didn't, in the end, you didn't go back to it. So I'll just explain perhaps what you meant is that when we, the capital controlled variable that we use focuses very extensively on portfolio restrictions and perhaps not on direct investment. So we're trying to look at ways to do that. We are thinking, for example, to use the OECD measure of FDI restrictions, which could perhaps explain that. So that's something that we're thinking about. In terms of the, how our model picks up, the panel regression picks up variation over time. I think that's a great idea, doing some time robustness. It was already kind of on our mind, but it's definitely going up in our sort of to-do list of things to do. We're going to do some more time robustness. In terms of, and I think perhaps the most important point is the partial explanatory power of these bilateral variables that we're using. We didn't show an R-square in the paper, so we don't have it right now. But one thing that we can that I could show you is sort of like is the graph where we relate the model rate of returns to the one that you mentioned that we take from another paper. We do evaluation. Now that I think that graph is important in terms of why our variables matter, because all the variation in rates of return across countries that our model generates, they come from these four various variables. If we didn't have those, rates of return will be equalized across country and model. And so and the correlation that we find between those rate of return externally from estimated independently in another paper in our model is 40%. So with these only four variables that we cannot immediately relate to rates of return, we can already get a very high correlation with the rate of return. Now, why is that important in terms of explaining capital misallocation? Because capital misallocation, and this is another result that we show in our model theoretically, is related to the degree of dispersion in rates of return across countries. So based on this, it's not a partial R-square, but we can tell that our four variables have a lot of bite in terms of explaining capital misallocation. So, but we can perhaps think about ways to, get a little bit more into that in the next version of the paper. Overall, great discussion. Thank you so much. I don't know if Romain or Enrico want to add anything.
Yeah, go ahead.
No, I don't have much to add. Thank you very much, Julian. This was a great discussion. We'd like to have your slides, and we're going to go through the bullet points and implement the robustness checks.
Yeah, likewise. Thank you very much, Julian.
Well, thank you very much, everyone, for an excellent session, and big thanks, especially to George for stepping in and saving the day. And yeah, so I look forward to seeing you all around, virtually or otherwise. Bye, everyone.
Good. Thank you. Bye.